Scroll through any comment section right now, any Reddit thread, any political debate. People are furious about prices, and the solution they're demanding is deflation, prices going down. I get it, I really do. When your grocery bill is climbing every month, you want the opposite. You want relief. But here's what nobody is saying out loud. What you're asking for would be so much worse, not a little worse. Catastrophically worse in most cases. And I can prove it. With real examples from Japan, China, Europe, and your own backyard. Stay with me for 10 minutes. This is going to completely change how you see the current economy. Let's start simple. Deflation is when the overall price level of goods and services falls over time. On the surface, amazing. Gas cheaper, groceries cheaper. That $800,000 house is now $650,000. But here's where it gets interesting. You go to buy that house, and then you think, wait, if it's $650,000 now, will it be $580,000 in 6 months? So you wait. And your neighbor thinks the same thing. And the couple down the street. And suddenly nobody's buying anything because everyone is waiting for prices to fall further. One person's spending is another person's income. When consumers stop spending, businesses stop earning. When businesses stop earning, they cut costs, starting with labor. Layoffs rise. People with less income spend even less. Prices fall further. Economists call it the deflationary spiral. I call it the doom loop. And once it starts spinning, it is brutally difficult to stop. Here's why. When this happens, the Federal Reserve's main weapon, cutting interest rates, stops working. You can't cut below zero. People still won't borrow if they think everything's going to be cheaper tomorrow. You've lost the tool. The economy is in free fall and the pilot has no controls. That is not hypothetical. It has happened, multiple times, to major economies. Before we get into the examples, I want to give you a framework that makes this all click. Milton Friedman, one of the most influential economists of the 20th century, compared inflation to alcoholism. He said both produce enjoyable short-term effects followed by severe long-term consequences. And curing either one requires a painful, delayed recovery period. Think about that. The buzz feels great going in, but you can't just quit cold turkey and expect to be fine the next morning. That's the trap people are walking into when they demand deflation as the cure for inflation. They're asking for cold turkey. And the withdrawal, in economic terms, can be a decade of stagnation, mass unemployment, and a frozen economy. The right answer isn't to swing from one extreme to the other. It's a controlled recovery. Now let me show you what happens when countries got this wrong. And in the interest of being fair, one case where falling prices actually worked. Here's something most finance channels won't tell you because nuance doesn't get clicks. There is a version of deflation that works. And it actually happened. Late 1800s. The Second Industrial Revolution. Railroads, steel, steam shipping, the telegraph. Technology was exploding. Productivity went through the roof. And prices fell, consistently, for almost 2 decades. But here's the key. Wages stayed flat or rose. So even though prices were falling, workers' purchasing power was actually increasing. Prices of most basic commodities and mass-produced goods fell almost continuously, but nominal wages remained steady, resulting in a prolonged rise in real wages, disposable income, and savings, essentially giving birth to the middle class. This is what economists call supply-side deflation, or good deflation. Prices fell not because demand collapsed, but because we got dramatically better at making things. Think about what that looks like today. Your flat-screen TV is 80% cheaper than it was in 2005. Your phone does things a $10,000 computer couldn't do in 2000. That's the same principle. Productivity, driven price drops that make everyone better off. So deflation isn't automatically evil. The type of deflation matters enormously. The problem is, the deflation people are demanding right now has nothing to do with productivity gains. It's demand, side deflation. People just want prices to go down because they're struggling. And that version, that's where the horror stories come from. You already know the broad strokes of this one, so I'll keep it brief. America, 1929. Stock market crashes. Banks fail. Deflation hits. Real GDP shrank 29% from 1929 to 1933. Unemployment spiked to 25%. And nearly 7,000 banks, a third of the entire U.S. banking system, failed. The deflation increased debt burdens, distorted economic decision-making, reduced consumption, increased unemployment, and forced banks, firms, and individuals into bankruptcy. This is the textbook case. It's famous for a reason, but let's talk about the ones that are less famous and more recent. Japan, 1989. Second largest economy in the world. Tokyo real estate was so expensive that the land under the Imperial Palace was theoretically worth more than the entire state of California. Then the bubble popped. Asset prices collapsed. Banks froze. Deflation set in. And Japan spent the next 3 decades trying to escape. The government tried everything. Zero interest rates, massive infrastructure spending, quantitative easing. Nothing fully worked. Because once deflation psychology takes hold, you can't just cut rates and expect people to start spending. Over the period of 1995 to 2025, Japan's nominal GDP fell from $5.55 trillion to $4.27 trillion, and real wages fell around 11%. Japan's share of the world's nominal GDP decreased from 17.8% to 3.6%. Read that again. Japan went from 17.8% of global GDP to 3.6%. In one generation, yes, an entire cohort of workers who graduated in the 1990s never fully recovered their earning potential. They call them the Ice Age generation. And here's what makes Japan haunting. They didn't choose deflation. It happened to them. But it started the same way these conversations always start, with a bubble, a crash, and prices that just wouldn't stop falling. Japan is still trying to create inflation today, because they know deflation is the real disease. You don't have to go back to 1989 to find this story. You can look at China right now. After COVID, everyone expected China, the world's second largest economy, to explode back to growth. Instead, the opposite happened. China's economy was roiled by a spiraling real estate crisis, falling consumer confidence, deflation, soaring youth unemployment, and the disappearance of foreign investment. Youth unemployment hit a record 20% in June 2023. And then consumer prices tipped into negative territory. Then the government did something that tells you everything. Youth unemployment became so bad, they stopped publishing the data. When the numbers are too embarrassing to report, you know things are serious. Chinese households, instead of spending, started parking record savings in bank deposits, waiting for prices to fall further. Sound familiar? That's the doom loop, starting to spin. In real time. Economists are openly comparing China's trajectory to Japan's lost decade. The playbook is identical. Falling prices, consumers waiting, businesses pulling back, government stimulus that isn't working fast enough. The world's second largest economy. Right now. Struggling with the exact thing people in the comments are demanding America do on purpose. Now here's the one that really shows how seriously the people who run economies take this threat. Because this was 2014. Most of you were adults. After the financial crisis, Europe started sliding toward deflation. By December 2014, inflation in the Eurozone had gone negative. In 12 out of 18 Eurozone countries, consumer prices were falling. The European Central Bank panicked. They did something that had never been done in the history of modern central banking. They set the deposit rate at negative 0.10%, meaning they were literally charging banks to hold money. A negative interest rate had never been tried on a wide scale before. They invented a brand new financial tool on the fly, just to stop prices from falling. Think about the desperation that requires. 19 countries, hundreds of millions of people. And the smartest economists in Europe are sitting in a room saying, we have to charge people for having money. We've never done this before, but we have to try something. It worked. Barely. Years of emergency programs, trillions deployed, while, on social media, finally, prices are dropping. Yeah, the people running the economy were absolutely terrified. Now, in the interest of being fair, and this channel is always going to be fair, these are not the only examples. Hong Kong experienced deflation from 1997 to 2004 following the Asian financial crisis. Their currency was pegged to the US dollar, so instead of devaluing, prices fell, and their economic slump was more severe and prolonged than surrounding countries that simply devalued their currencies. Ireland hit deflation in 2009, one of the first times since 1960. Switzerland sustained mild deflation from 2011 to 2016 after the financial crisis. And while their economy held up better than most, it still required the Swiss National Bank to implement negative interest rates to fight it. Boris, and the US itself flirted with deflation in 2009 and again briefly in 2015. And the Federal Reserve responded both times with emergency measures to prevent it from taking root. The pattern across all of these cases is consistent. When deflation is driven by demand collapse rather than productivity gains, it causes serious damage, and it always requires extraordinary intervention to stop. So here's the honest answer to what people are really asking for. You don't want deflation. What you want is disinflation, inflation slowing down, combined with wages that grow faster than prices. Those are very different things. Disinflation, prices still rising, just slower. Getting from 8% back to 2 or 3%. That's the goal. That's what a recovering economy looks like. And that's actually what's been happening. The version of this story that ends well isn't prices crashing back to 2019 levels. It's your paycheck growing faster than your grocery bill. That gap, wages over prices, is the only scoreboard that actually matters for working people. And practically speaking, here's what you can do right now while that gap closes. Stop leaving money in a regular savings account. High-yield savings accounts are paying 4 to 5% right now. That beats low inflation years, and it's available to anyone today. Invest in assets that outpace inflation long-term. The S&P 500 has averaged around 10% annually over decades. Index funds are the most boring, most effective wealth building tool most people ignore. Look in the description below for tools on wealth building. Negotiate your salary like your purchasing power depends on it, because it does. A 2% raise in a 4% inflation environment is a pay cut. Don't accept it and call it a win. Here's the bottom line. Deflation is not the economy going on sale. History shows us, from the Great Depression to Japan's lost 30 years, to China right now, to Europe in 2014, that demand-driven deflation is one of the most destructive forces an economy can face. The one exception? When deflation comes from productivity and innovation, things getting cheaper because we got better at making them. That version can be genuinely good. Your smartphone is proof of it. Upsells. But the deflation people are demanding right now isn't that version. It's I'm struggling and I want prices to go back down. And the cure for that, historically, has been worse than the disease. What you actually want is wages that outpace prices. That's the goal. That's the version of this story where working people win. Milton Friedman was right. You can't quit cold turkey without withdrawal. But with the right policy, the right patience, and the right personal moves, there's a version of this that ends well. If this changed how you think about the economy, subscribe. One big concept, every week, in plain English.